just gone through the midpoint of my questions. We talked about, it's only going to get harder. We talked first about the general market conditions, then we moved on to how the buyout industry is changing specifically. And now our third part is what's going to happen next. Let's talk a little bit about some of the public companies that have been gone, some of the public buyout companies that have happened. I'll start off with something that Stephen Schwartzman said. He's the CEO of Blackstone. For those of you that don't know, they had a very large IPO a little while ago in June. And he said, people look at our equity as a reflection of the availability of credit. That was what he said when his stock was trading under $10. He went out at $31 in June. And anybody who's done any investing in Blackstone is probably smarting right now. The question is, what's this going to happen for, what is this going to mean for KKR, Apollo, some of the other firms that have been talking about going public? Are they going to think twice or three times before they pull the trigger on this?
I hope they do. Our firm doesn't see a real rationale or need to go public. I think if you just looked at Blackstone when it went public, a lot of people who are valuing businesses, I think they were valued at something like 5 or 6 times book value for an asset management firm, which is just crazy. So I think most people just would say it was just wildly overpriced, just looking at it.
Yeah. In terms of, if you're a founding partner of a firm who doesn't want to be there in perpetuity, or you can't be there in perpetuity, an IPO is a great way to monetize something. In our business historically, it doesn't figure out a great way to monetize for people as they move out. So if you're a partner in a firm like KKR, it makes a ton of sense. I think if you're the new money going in, you take inherently illiquid deals that we're doing, all predicated really on capital gains. We're not here to get quick, 8% coupon. We're here to put money in and hopefully take out a much bigger part of that 5 years later. That whole model just doesn't lend itself to quarterly earnings and predictability. And so a little bit of it, in my mind, it's kind of a square peg and a round hole. But hey, I'm sure some investors at the right price and the right multiple of book value, it's going to make sense again. But it's I don't think.
Are we going to see more of it in 12 months or the next 18 months?
I think you'd think this has got to be one of the last things to come back around. Listen, the public hedge funds, they're trading probably 90% below where they were. So I think probably private equity and hedge fund as an asset class will be the last to come around. You'll see Goldman Sachs and Citigroup and other groups trading at historic levels before you see the private equity groups back trading at their historic levels.
Washington Mutual aside, some people think of TPG as a pretty smart firm. They managed to raise $30 billion this year as some of the credit crisis was happening. Now it's going to use that money to go off the beaten path to places such as Israel and Russia. Is that something that any of you guys have thought about, is investing abroad for your buy?
Well, we do invest abroad. We invest about a third of our money outside of the U.S. Now, that's mostly Europe, almost all Europe, although we're looking at Israel right now. But for us, it's really first world countries. So we would not do emerging markets. We would not do Russia. But that's just us. We don't think we have that skill set. Is it smart to be playing in the global market? I think so. You have to be really careful in some of those places. But if you've got the expertise and all the partners, there's definitely money to make.
We have a London office, and we actually have a $1 billion Euro fund there. And the London office has been very active. In some ways, Europe is maybe slightly less mature than we are here, so there's lots of opportunities there, and we've had some very good deals in Europe.
No South America, Asia, Russia?
I would agree with what Scott said. You really have to feel like you know the markets. We sent one of our partners who was part of the culture of our firm over there, and then what they've done there is recruit people who speak every single language all throughout Europe, so that when we can call a CEO, we're speaking that person's language and understand the culture. We wouldn't go to any place unless we felt like we could do something like that.
We have a handful of things in Latin America industries that we think we know pretty well. We're much more of a specialized fund, really just in communication services and media. So we found a handful of things in Latin America within those sweet spots, but it's a little bit of a roll of the dice. We have one company right now that we did for a while that was money losing. We get into it, and through organic means, it's got about $40 million of EBITDA right now. So you think, well, that's a smashing home run. A lot of that's in Brazil. You could
changing target always.
Right.
But 25%, do you see any new emerging players that are going to be making loans, maybe get their start now?
It's a very interesting question because, in fact, we talked about it at our firm level, which is whether we should hire people and raise a fund within our construct in order to finance great deals that can't be financed right now. Because I will tell you, just a ton of deals where I would personally love to invest my own money in the kind of capital structure that you can get, the yields you can get. We decided that we didn't, that we're basically not senior lenders. That's not what we do for a living, and we decided we weren't going to just jump in the bandwagon and do it. We hope others people do it, so it helps free up the markets, though.
Sorry, we had the same conversation last week, came to the same conclusion. But the fact that two of us sitting here had this conversation means others are as well, and someone will come in. And it's funny, I'm talking about GE, you know, we use GE a lot. You know, they told us they're done for the rest of the year. No new loans, done. Right? So when there's that much dislocation, someone's going to step in. And one of our LPs told us that they've allocated $13 billion of new capital to go into debt origination. Right? So there's capital out there looking to flow and fill a void, but it's going to take a little bit for it to show up, I think.
Regulation, seems to be the inevitable response to any downturn. We saw it after the buyout, after the dot-com boom with Sarbanes-Oxley. What are we likely to see from Washington in the coming year or year and a half that may variously either help or hurt the buyout market?
I think this is what, people are worried about, which is just moving too far one way. I mean, a lot of the students of what's happened in history and, Laffer of the Laffer curve writes about this all the time. Feels like the
Pepperdine guy, by the way.
I wish I knew that. He basically is constantly worried about the over-regulating. Most people in our industry feel that Sarbanes-Oxley was an unqualified disaster. And we are all generally worried about doing things that sound good politically or what have you that don't make a lot of economic sense at the end of the day. So, and most of us are worried about too much regulation.
I'd be surprised if it comes out and says, you can't lend more than 6 times a private equity company, or you can't go do a dividend recap. If God help us, dividend recaps come back, where we can borrow money to repay ourselves a dividend. So I think what you will see, what you're seeing now in Goldman Sachs, listen, they're now a regulated bank holding company, and that they're just not going to have the freedom to go to the deals they once did. So I think it's going to trickle down from that, which is they're going to look at their cost of capital, and they just can't take as many risks, and it's going to be passed on to us, and you can be in a realm of, by definition, the loans are going to end up being 4 to 5 times deals instead of 7, 8, 9 times because of some of that regulation.
We've talked about a lot of difficult things this evening, but I've got good news for you now. We're almost done. We're coming into the home stretch here. I'm going to call this section News You Can Use. Are there any Pepperdine students, either at the business school or undergraduate, here tonight, recent graduates? You can raise your hand. More than a few. You'll be interested to know that if you're in this room, you're already well on your way to a good career. Analysts, those are the people that would be coming out of the undergraduate in going into the buyouts market, made last year on average $307,000. That's in their salary and other compensation and bonuses and any taste they had at the carry and interest. That was at the biggest buyout shop. Now, senior analysts, the people who are just